We are moving into our thought discussion and our thought leadership panels, and I'm really thrilled to introduce and to welcome to the stage Duane Lunde. Duane is the CEO of NAI Legacy. He's a 30-year veteran of the real estate industry and is also the president of Exchange Realty, Inc., a private investment firm that is focused on the acquisition and ownership of commercial real estate assets. Duane, I've only got to know you over drinks last night, but you seem like an amazing professional and expert. Welcome to the stage, as well as your panelists. Excuse me, sir. Thank you. Thank you, Duane.
All right, good morning, everybody. Thanks, Jock. By the way, I was the one that said, how do we make money? It was me. Great to be here. As Jock mentioned, my name is Duane Lunde. I'm the CEO of NAI Legacy. So for the NAI people in the crowd, I'm your Minnesota partner. Thank you. New to the company, joined NAI about 4 years ago. So we're not going to talk about what's going on in Minnesota. We're going to talk about real estate as a tax tool, okay? Real estate as a tax tool. Now, I'm a former CPA, and basically, real estate as an asset class, we've really enjoyed favored nation status under the code for a long, long time, and I basically built most of my career using real estate as a tax tool and packaging real estate and selling it mostly to tax-motivated investors. So what we're going to do today on this panel, and I'm surrounded by a bunch of experts, we're going to talk about real estate as a tax tool and how you can use that to help your customers and maybe even help your own tax return. So let's do this. Let's just go down the row. We'll do a quick, just do your introduction, and then we'll jump into the PowerPoint. So Janet, why don't you start?
Good morning. I'm Janet Schaum with Old Republic Exchange Company. We're a nationwide qualified intermediary for 1031 exchange.
How are you? I'm Tunde Ogunlana, founder of Axial Family Advisors, and we focus on helping families transfer wealth through the generations and asset management.
Hi, I'm Rob Gilman. I am partner and leader of Anchin's Real Estate Services practice, a full-service CPA firm. Our real estate practice helps our clients save money with strategies for transactions.
Good morning, I'm Spencer Lund. I'm the Chief Investment Officer at NAI Legacy, so I work closely with Duane, and I run our investment platform in Chicago.
Good morning, I'm Jim Lockhart. I'm a tax partner with Anchin, and gonna help you figure out some tax strategies.
All right, so here's what we're going to do. There's the intro. Here's the agenda. Now, there's 2 to 3 hours of content in this agenda. We're going to do it in 20 minutes. Okay? Now, we learned that on Tuesday, that we got to cut from 50 minutes to 20 minutes. So here's what's going to happen. We're going to talk about using real estate, how you can use it to deduct against your income, how you can defer it using 1031s, how you can contribute it using 721s. These are all code sections. And then ultimately how you can transfer it, through different trusts and estate planning. So we're going to hit these topics. We're just going to hit top level, not drill deep, but hopefully it'll provoke some thought, and then it'll lead to some emails at the back end. But let's start with individual tax strategies, and I'll set the stage. So by being in this room, you're obviously in the real estate industry. And if someone were to ask you, what do you do? Maybe you say real estate. But the IRS, just so you know, looks at it differently. Okay? So some of you, probably like me, I'm going to file my tax return in the next 10 days, and there's that line on your Form 1040 where it says profession. Real estate professional is what you want to put in that box if you're a real estate professional under the code. But what most people don't know is the IRS looks at that pretty hard. Okay, so just the fact that you're in real estate doesn't mean you're a real estate professional under the code. So let's start there, because we need to make sure everybody in the room can take advantage of depreciation by saying you're a real estate professional. And Jim, why don't you start with talking about what it means to be a real estate professional under the code versus as a profession.
Right, so I'm going to keep this at a very, very high level. And as we only have a few minutes, and as Duane mentioned, being a real estate professional is really important, as I know many of you know, and it goes hand in hand with cost segregation, and I'm going to talk about that next. And it goes hand in hand because through real estate investment, you can generate tax deductions. I always say real estate's the last legal tax shelter. And through cost seg, you can generate all of these deductions. And when you're a real estate professional, you can offset the deductions from your real estate investment against your income as a broker and other income as well. And a lot of us know that, and a lot of us are real estate professionals. But for those brokers in the room who are W-2 employees, they're like, how do I qualify? This is hard because you can see that over half of your services have to be with real estate services, and as a broker, that is. But there's also this 5% ownership test. You have to be a 5% or more owner in a real estate business. And if you're a broker that's getting a W-2, you don't qualify as a real estate professional. So what do you do to get around that? Well, there's really a couple options. One, you can form a loan-out corporation. So if your employer will contract with your own loan-out corporation, which is an S corporation, now you own the S corporation, and you now own more than 5% of a real estate business, so you can qualify. Well, you say, well, my employer won't do that, so what else can I do? Well, if you have a spouse who has time and is not working, and you make other real estate investments, your spouse can qualify as a real estate professional as well, and then thereby can offset your income as a broker and what other income you may have. And so Duane's right, the IRS looks at this very carefully. You have to keep really good records as time spent and things like that, but it is possible to make that designation. So if you have questions later, I'd be happy to answer them and talk about them. So the next topic, do you just want to?
The cost segregation?
Yeah.
Yeah, so in its simplest form, then Jim can fill the color. So if you get that designation real estate professional, and we work with a lot of clients at our shop, and a lot of our clients are investors, but they happen to be in the insurance industry, contractors, but their spouse happens to be a broker.
Right.
And if one of the two qualifies, you now can take that loss as a real estate professional and offset other income. So it is a big deal getting qualified. If you're not sure if you're qualified, just shoot Jim an email. I want to know if I'm a real estate professional, and he'll answer that question for you, at least do the work. And then once you're a professional, here's the beauty of real estate right now is taking advantage of depreciation and some of the benefits we got in the 2017 Jobs Act and cost segregation. You want to talk about it just quickly, Jim?
Yes, so I'm sure some of you or many of you own real estate and have done cost segregation studies. It's a very powerful tax tool. And basically what you're doing is through an engineered study, you're going in and you're classifying that asset, the asset from 39 years or 27 and a half years if it's multifamily, down to 5, 7-year, and 15-year assets. And that's really powerful because you're accelerating the tax depreciation. Now, what people have been doing because the change in the tax law, they've had this 100% bonus. So of those assets that you break down to 5, 7, and 15 years, you're now able to take that immediately, right? So let's say you buy something for $10 million and you allocate 30% of the cost to shorter-lived assets, you can take that $3 million deduction in the year of acquisition or whenever it's constructed and offset your income, and to the extent it generates a NOL, you get to carry that forward. Well, a lot of us know that, as Duane just put up this slide, that this bonus depreciation is going to be phased out. So for 2022, it's still 100%, and you can see it's going to phase out 20% for the next 4 years. Now, notwithstanding a new administration coming in, this could obviously change. Tax laws change all the time. So, but for now, it's set to phase out.
And let me just give, so here's how we use it at NEI Legacy, and we help our real estate brokers get deductions. This is a store that we're actually, a convenience store we're buying in Colorado. It's a Come and Go, which is a brand out of Des Moines, which was just acquired by Maverick. But take a look at this deal. We're buying this for $9.6 million. We actually put it in a DST form of ownership. And in 2023, because we're building this store right now, we'll write off $6.144 million the first year under this cost segregation rule. And convenience stores are deemed to be personal property, but for the land, okay? So what we do with a transaction like this, we put it in a DST, and a lot of our NEI brokers buy into this syndicate to get the tax loss. So for every dollar you invest, you get $1.64 of depreciation the first year. And we sell this cost segregation product as a company every December. It's crazy how many people call us, Duane, what do you got? I need some tax losses. So we syndicate a lot of deals like this. And if anyone has an interest in seeing how we structure these, just shoot me an email and we'll send you the full offering memorandum. But we use this to help our brokers shelter their income. So that's a live example. And then here's some of the percentages by asset class, if you're familiar with cost seg studies. So we do them on all of our assets, and convenience stores, that's the most lucrative one. But even our industrial buildings, we do cost segs and we write off anywhere from 15 to 45%. So that's a snapshot of cost seg. So that's the tool we use to deduct our real estate assets from our income. Okay, now we're going to go to exchanges, 1031s, and again, just hit it high level. So Janet, maybe just 1031s have been in the code since, what, the 1920s? From time to time, they talk about taking it out, but what's the state of the union in Washington and what they're saying about 1031s?
Well, right now, I think we're safe, thank goodness. There was talks of putting caps on the 1031 exchange, talks of eliminating it completely altogether. But as of right now, they are safe. The 1031 exchange without the 1031, obviously we know not a lot of transactions would happen without the 1031, so it's a great tax strategy for real estate investors, both big and small. But as of right now, it seems to be that it's being preserved.
And some of the state considerations, Janet, maybe you can chime in as well. So we as a company at NEI Legacy, we run a 1031, I'll just call it a tax syndicate. We structure these DSTs. Spencer's going to talk about that in a moment. But we have clients now in 46 states that have done 1031s with NEI Legacy. We have about 200 investors. And some of the more lucrative states that they're asking about are the no tax states, Janet. And I don't know if you see that at your shop.
Definitely.
Yeah. So this is just a quick snapshot of the United States. Our business in Florida is number one. It's crazy how many of our clients, we have about 40 million invested here in Florida, are say, Duane, get my basis down to Florida, or get it to Texas, Nevada, South Dakota is one of our hot states for our Midwest money, and Tennessee. Those are our top 5 states as far as where we're putting our 1031 money. And residency, which someone did mention early this morning, people moving, I think Jay mentioned it, people moving from New York or Illinois or high tax states to states like Florida. Let's just talk a little bit about residency, Rob, because it's a little bit more than just taking 365 days and divide by 2, the way the IRS looks at it. And so Rob's just going to hit some high-level thoughts if you have clients looking to change their residency for tax purposes. So,
yeah, and
go ahead.
Thank you. And I think it becomes more prevalent with real estate professionals and owners in the, let's call them the high tax states that just moving to the beautiful state of Florida. The other states don't appreciate it. But a couple of misconceptions that people have. Becoming a Florida resident does not exempt you from state income taxes if you have assets in other states or you're earning income in other states. Also, just being out of a state for 183 days. So if you were in Florida 150 days, New York 100 days, and traveling, the rest of the year, that still does not change your residency. So what about being in Florida for 183 days and New York for 100, and just using New York, but there's a lot of aggressive states. The answer is maybe. And there's a lot of facts and circumstances that come in. And I think, many of my clients that are real estate owners and developers that try to move out of the state of New York for tax purposes, there's a couple things. All their assets are in New York. Do they manage the assets? And, a lot of times, people, where they feel, and it can happen, they can manage, assets, remotely, in this day and age of remote, hiring management companies to manage your assets if you have in other states is important. But one of the things, and I think if you have clients that are really looking to change their residency and maybe to generate more business for you, and many of my clients have done this, you know, they move to Florida and they start buying assets in Florida. And a reason for them to really establish a Florida presence as to what reasons for being here. High tax states are extremely aggressive. You know, just changing your license and voter registrations is not going to be enough. You know, some of the things to look for, you know, if the states do audit you, and there are people that, you know, that day test is a little, you know, it's close, but what they'll do is the states will come in, they'll look at your, just having a cell phone with a Florida phone number is not enough. They'll get the cell records. They'll check your credit cards. They'll check your Easy Pass. You know, we have a client now that was going through a residency audit, and his kids had his Easy Pass. And, you know, New York State came in and said, well, you were in New York. So it is difficult, but the one thing that I think that, you know, when you're speaking to your clients and investing in real estate, you know, it's facts and circumstances. You have to have, you know, the right story. And really being in another state and generating all your income makes it very difficult. And in some situations, you know, you may have clients that you just may have to sell their real estate in other states just to be able to, you know, pass that residency. I will tell you, New York, New Jersey, Connecticut, California, and I found that last night, Minnesota,
Yep.
is extremely aggressive, and they're not very happy with all their residents that claim to now be Florida residents. But something to be aware of, and you know, you have to plan for this. Your clients have to plan for this, and it's not just a quick 183 days and you change it.
And it's interesting, even though we're NEI Legacy, we're a brokerage company, we actually have clients that ask our opinion about residency as they're trying to move from different states. And if you have any clients like that, just send Rob an email and he'll take a look at it. And there's this one other slide. Sorry, Rob, I missed that last slide there for you. But so these slides will be available, I think, for everybody afterwards. Okay, real quick, we're just going to hit 1031 vacation homes, Janet, because we get a lot of clients say, hey, Duane, I want to move my bases down to Florida, but I actually want to buy a condo. Can I do that? And so believe it or not, I would say 10% of our 1031 business is money coming out of an investment deal to buy a vacation home, and you can do it. Here's how it works. Here's the one slide. So go ahead, Janet.
Yeah, so vacation homes, you do have to be mindful. Vacation homes are different from second homes. Obviously, second homes are strictly personal use, but we are seeing a lot of clients buying vacation homes that they maybe have some minimal personal use, and they're changing these into like Airbnbs, you know, Verbos, that kind of thing. But it has to be, there is an ownership period. So for it to qualify as a vacation home, you have to own it for at least 2 years, okay? Anything less than that could be a potential audit risk, obviously, for the exchange, but particularly with vacation homes, there is a 2-year mandatory holding requirement on those. So that's very important that the taxpayer that they understand that. And in each of the 2 12-month periods preceding the exchange, they need to have rented the unit at a fair market value for 14 days or more, and the taxpayer's personal use does not exceed the greater of the 14 days or 10% of the rental days. So what I tell people to do, you know, when you're considering using a vacation home and acquiring that through a 1031 exchange, you do want to minimize, like, you don't want to make it like your second home where you're living it for 6 months out of the year and then trying to rent it out for a couple of weeks and still try to qualify it as a vacation home. So you do have to be mindful of those. But vacation home, definitely a great investment vehicle for taxpayers looking to reinvest funds from the sale of investment property through a 1031 exchange and acquiring a vacation home. But obviously there's other things you can do too, but vacation homes, like Duane said, are a great prospect.
Yep, we get asked about it all the time. Okay, let's hit some advanced tax strategies. We'll fly through this, talk a little bit about some contribution techniques. Let's start with Delaware statutory trusts. If you've not heard of them, Spence is going to give just a snapshot of what it works and how they're set up. And this is basically 1031 money. We buy by the brick, sell by the share. Basically sell 1031 interest as a security using a DST. And Spence, why don't you give the snapshot for the audience?
Yeah, so starting out with just the structure, we put an org chart up there with some pictures to kind of just set the stage. But essentially what a DST is that trust structure where investors own a beneficial interest in the trust. That trust then owns a fee simple interest in the underlying real estate. And that trust is managed by what's known as a sponsor. So NAI Legacy is a sponsor of DSTs. So the big thing with DSTs and why it's involved in this tax panel is there was a revenue ruling in 2004 that deemed those interests to qualify as real property, meaning that you can 1031 exchange into a DST. So one of the beautiful aspects of that is that if you look at this kind of graphic, a traditional 1031 exchange process from the eyes of an investor requires you to go through the entire acquisition process of that real estate. The beauty with the DST, you'll often hear them known as turnkey solutions or prepackaged investments. That entire acquisition process, including placing the debt, has happened. And so you can 1031 directly into an asset that's ready to go and complete that 1031 as quickly as you can get through the due diligence. So we are a sponsor of DSTs. Our DST platform is predominantly in the Midwest and the Southeast. We have about 255 million in total offerings, and there's some pictures of some of our assets, and we have a pretty strong presence down here in Florida as well. And then we are part of the larger 1031 DST marketplace. So last year, that marketplace raised $9.2 billion of equity. This year, we're looking like we're going to come in right around $5 billion of equity raised across sponsors in the space.
Okay, and just to put a snapshot on DST, so if you have 1031 clients looking for a solution, we have some of that product. And we do these as private placement memorandums. We file them with the SEC. And again, the beauty of it, and we get the calls all the time on day 44, day 45, hey, Duane, what do you have? I need to identify something. We always have inventory at our shop, but we can also accommodate NEI brokers. So if you have clients looking for a turnkey solution, it's not uncommon. We'll get the order in the morning and we close the transaction in the afternoon. All those due diligence docs, we have this digital investor kit. They just go in, they can review all the financial statements, all the environmental reports, and it's an interesting way to get a 1031 deal done quickly. Because again, we buy it by the brick, sell it by the share. And most of our product is actually sold by broker dealers. So if you hear it of DSTs, just know you have a partner in NEI Legacy within the NEI system. Okay, 721s, I'm just gonna hit this real quick. We do a lot of 721 deals. Most people think of them as UPREITs in our industry, umbrella partnership, real estate investment trust. Well, the 721 provision is a partnership provision. We actually use it for non-UPREIT deals. And it's probably our most common acquisition technique at NEI Legacy. Basically, we work with families and individuals that are in partnerships where partners want to go separate ways, not because of they don't get along, it's because lifestyles have changed. So we've used this 721 technique to break up old partnerships. And basically, in its simplest form, the partnership contributes the property to a DST, that's tax deferred under 721, and then we cash out the retiring partners. Okay, so a lot of the partners actually stay in the deal. This was a little example. We did about a $5 million deal in the Twin Cities. There were 19 investors in this property for over 20 years. Half of them wanted in, half wanted out. A few of them actually passed, and so their shares went to their heirs. But this 721 technique is an acquisition tool we use at NEI Legacy. So if you have any clients that are in partnerships and some partners want in, some want out, think of this technique or just give me a call. We'll send you kind of the roadmap to how we do it. But this is our number one acquisition technique at our company, is doing 721s. And then we're combining it right now with a REIT format. So there'll be this retirement platform REIT. Back in the 90s, I was in the REIT industry. I was a CEO for a public REIT for a while, so very familiar with how the REIT rules work. But we're combining 856 and 721. You'll hear more about this next year when hopefully the REIT markets rebound a little bit. All right, so we've now bought it, we deducted it, we deferred it, we contributed it, and now it's time to transfer it, Tunde. So take over and talk a little bit about real estate estate planning.
I'm just smiling because now it's time to die. We're starting a nice Friday morning in South Florida talking about death and taxes, so I apologize, everyone. No, but that's unfortunately the fun stuff I have to do every day. is talk about death. So yeah, this is really about, a lot of people I find in the real estate world, especially commercial real estate, think about the now and about everything we've talked about, especially that beautiful presentation from the Fed person telling us about the economy, but then they don't think about how it can all fall apart when we pass. So on a serious note, this is clearly a very individual discussion for each person and their family. So we're not going to get through too much today, but on a few topics I'm seeing here, one is the lifetime unified credit. I think that's a very important thing to discuss, similar to the bonus depreciation, the things that came out of the 2017 tax reforms. And so we now have what's called a lifetime estate exemption of $12.92 million. Let's just use round numbers here. If we round it up to 13 million, that means anyone who dies with an estate below that number, their family faces no estate tax, but anyone with assets or a net worth above that number, their family would pay, at today's rate, about 45%. So hypothetically, if someone died with an estate of 20 million with no planning, the $7 million over the exemption will be taxed at 45%. And the IRS wants the money by the next April 15th, deadline. They don't want a wall. They don't want anything other than cash. So, sometimes families, unfortunately, have to face fire sales in order to raise money to pay the tax. So there are a lot of techniques, from trust planning and other forms of gifting, family limited partnerships, where you can gift assets to a family limited partnership, and the IRS will allow for certain discounts. But the big thing is that in 2025, or at the end of 25, let's call it January of 26, the estate tax exemption is supposed to sunset back down to before where it was prior to 2017, which was 5.6 million. So again, if someone has a net worth now that is exceeding 5 million, they may want to do some planning, because the IRS has already put out letter rulings that they will not claw back anyone that has moved assets out of their estate for avoiding estate tax in the future. So hypothetically, if someone is let's say, worth 15 million, just to make the numbers easy, they can now, within the next 2 years, move 10 million out of their estate, let's say to an irrevocable or charitable trust. 5 million remains. The 10 million that was moved out of their estate can grow to 30, 40, 50 million. If that individual dies 20, 30 years from now, and there's been no change in the estate tax, that money that was moved out and was allowed to grow is not taxed, is not taxed for estate tax purposes. So these are techniques that families have been using for, the last 100 years, and it's something that we're happy to discuss with anybody individually. And here's some of the additional kind of, just like in your world of real estate, there's all these names and acronyms, we have them too in estate planning. So there's, dozens of different ways you can use charitable trusts, personal family endowments, things like that. Again, we can get into 3 hours of a discussion, but that's really an individual discussion with a family as far as their own goals and how they want to leave a legacy. So,
yeah, and so why does this matter for NEI brokers? We've found at NEI Legacy, we're now managing assets for families that want to remove themselves from active management, and they're taking advantage of trust. So we're actually doing some asset management contracts at NEI Legacy for trusts that were set up by high net worth individuals. So it's actually become a fee business at our shop, and it's an important kind of tax tool, and more families are starting to move their asset into these trusts, especially dynasty trusts, and then we get the asset management contract at NEI Legacy. So it could be another tool to generate some revenue for NEI offices and NEI brokers. All right, we got through it in 20 minutes. Not bad. So let's do a quick Q&A, and then I think we hand it off to the next panel. Any questions that we can answer? Yep, go ahead.
What about opportunity zones, and how are they used today? They seem to have died off, at least in the public newspapers, et cetera.
Do you want it, Rob?
So part of the reason why, first of all, they still are a valuable tool with clients that are looking to invest, in certain areas. Why it's died down is the benefit was that if you held the asset for 5 years, you got a 10% basis reduction of your original gain. You held it for 7 years, you got another 5%. The taxes were going to be due the end of 2026. We're now in that window where it's only 3-year deferral. So unless anything changes, I mean, it's still a deferral. You don't get the step up. But the big benefit of opportunity zones was always that if you held the asset for more than 10 years, 100% of the appreciation was not going to be taxed. So there are still many opportunity zones, but it's slowed down a little only because that time frame and the current benefit, it's more of a long-term benefit.
All right, I think we want to probably keep moving on. So, but shoot emails to this group, shoot them to me, any questions you have about any of those different topics, and I'll pass them on to the panelists. So thanks for having us. And you want pictures?
Yes. Yeah,